I think it's a key point to make that maybe you're starting to see some of the data here in the U.S. slow down, but that does not necessarily mean recession.
I think it doesn't mean recession in the immediate term, but if you look at financial conditions, they've basically getting either unchanged or tighter for the last 11 consecutive weeks. The odds of a recession are increasing, not to the point where we're going to have one in the next 6, 9, or even 12 months, but it certainly says that when you see the odds increasing about 12 to 18 months into the future, guess what? You do get a recession. In fact, today's conference board numbers, what did you see? The futures conditions actually weakening. The labor market is tight. People are feeling that jobs are plentiful, but they're telling you that somehow 18 months from now, things can get a little bit softer, and that's what financial markets are keying on. Remember, financial markets don't reflect what's going on today. They reflect what's likely to happen a year or 2 years from now.
Yeah, and sort of to that point, John, the fact that we are arguably, there seems to be a very healthy debate right now about whether we're in a bear market for equities. I mean, you can have that without having a recession, but at what point, if there is a point, does one bleed over into the other?
Well, the problems with the equity market feeds into the cost of capital. And what we're seeing is that factory orders numbers are weaker in the last 3 months compared to 6 months or a year ago. And in addition to that, when we're looking at slightly higher interest rates. So that's how that process of the equity markets, corporate profit expectations slowing down in 2019 relative to 2018, that's what's feeding into that equity market hit, even though we talk about the current economy being pretty solid. And again, picking up on Steve's point, jobless claims were really pretty good. And overall, the American consumer is good. But one area that I would be concerned about would be autos. Auto delinquency rates are rising. Auto retail inventories are high relative to 6 months ago. Maybe Phil LeBeau has an opinion on that. But generally, the economy today looks pretty good, and expectations should be around 2%, 2.25% for next year as well.
Hey, John.
We have not been hearing complaints about credit quality yet.
Not yet, but we're seeing non-financial corporate debt as a percentage of GDP really reaching those levels that are consistent with a slowdown to a possible recession. But with respect to bear markets and whether you get a recession, since World War II, we've had 14 bear markets. And guess what? 65% of the times you get a recession, but another way of saying that, 35% you don't. So it is one of those things you have to watch, but it's not the all tell all.
You know, Steve, you mentioned here a couple things. One, the shutdown. Two, the trade tensions at this point. Those are Trump's babies. At this point, if the president decides he wants to end the government shutdown and not hold things off over this wall, if he moves forward, there's been this meeting reported in China that potentially could bring us closer to calming some of these trade tensions. Could that ease off some of these concerns over looming recession?
Yeah, I mean, the term of art that's used in this regard, Contessa, is unforced errors, right? These are things that a lot of them could go away pretty quickly. And you saw, for example, I mean, who knows why the market rallied 1,000 points yesterday. But, you know, when Kevin Hassett came out and said 100% the Fed chair's job is safe, you know, sometime thereafter, the market took off. And obviously other things were at work, like the algorithms and the, you know, an undervalued market at that, maybe an oversold market at that time. But the issue with that could go away. A meeting, and by the way, later on in the day, the market might have got a little more motivation from a wire story that said China and the U.S. would be meeting. Now, we kind of knew that would be happening, but there was a wire story on that. I just want to throw back to John this issue. John, one of the things that we saw earlier this year, and that surprise index really that we had up earlier underscored it, we had a lot of upside surprises. A lot of the data we had hit really, really strong levels. Now, I get that directionally when you're on the roller coaster and you're going down, you think the only way to stop going down is to hit the bottom here. But is it possible here that what you have is a come down from these high levels and that you end up going straight and stabilizing at more normal averages?
Oh, absolutely. There's no imminent, as you said, indicators of recession over the next 6 to 9 months. And I certainly agree with Anthony in the short run that's certainly true. I'll go back to your X factor point. There was an earlier discussion on CNBC this morning about uncertainty and risk. And I think what we're dealing with, a lot of X factors are uncertainty. But definitely an economic slowdown seems to be in the cards, not necessarily leading to a recession.
Anthony, last hour we had a big conversation about the Fed and specifically about disinflation and whether we're starting to see that with crude prices, other commodity prices, et cetera, starting to come down. Do you think that's going to be a bigger theme in 2019?
I think in 2019, the Federal Reserve is realizing that with the tightening in financial conditions and, in fact, commodity prices so weak, you saw the big drop in oil prices, that's certainly going to spill over into the economy. Less pressure on the Federal Reserve to actually act. And they certainly are starting to see that, saying that with John Williams' speech and all the other messages that you're getting from the Federal Reserve. Less urgency to act. But nonetheless, the labor markets are tight enough that the economic fundamentals are still telling them that 1 or 2 rate hikes are still justified, but they're looking at other things now.
And you think it's going to be 1 or 2 rate hikes next year?
I don't think it'll be more than 1 or 2 rate hikes next year. But if financial conditions continue to tighten, they might even step back away from that.
John, your thoughts on this?
Yeah, I think Anthony's got it right. 1 or 2 maybe at most. More likely 1. But when you look at the inflation numbers, and I'm sure Steve can ginny up a graph on this, there's a huge disparity continuing between the cost of services and the cost of goods. And we've had deflation in goods for a number of years here. So I think that discrepancy is really going to limit the Fed's actions, and they'll look at this, and I agree with Anthony, 1, maybe 2, but more likely just 1 move next year.
Steve, I'll give you the last word.
Well, I mean, the trouble is the X factor again, which ends up being how tariffs end up affecting the inflation output and how the Fed folds that into its forecast, because tariffs have this stagflationary whiff about them, which is they tend to reduce growth and increase prices. So I think, when the Fed looks at what's happening on the trade side, it says, thanks a lot for nothing over to the administration, which is making their job a lot harder. And I think it's possible that if you have a tight labor market, you have tariffs end up pushing up prices, that you may get the Fed doing a little bit more if the tariffs have that kind of effect.